Want to grow your money while you sleep? Then investing might be the answer. And no, you don't have to be rich to get started. My name is Rick Ruda, a money coach, helping Canadians take control of their finances. Today, we're talking about how to start investing, even if you're a beginner. And stick around to the end, as I'll be sharing a step-by-step plan on how to invest, even if it's just with $100 a month. What is a stock? When you buy a stock, you are actually buying a small piece of a company. So, for example, if you buy one share of Apple stock or one share of TD Bank, you own a piece of that company because those are publicly traded companies. If the stock or the company does well and the value of it goes up and you end up selling it for more than what you purchased the shares at, you make a profit. Some companies actually pay dividends quarterly or monthly, and that's the other way you could make money from stocks. Conversely, if you buy a stock and then you end up selling it when it goes down, you can lose money. What is a bond? Essentially, when you purchase a bond, you're giving a loan to a company or government in exchange to get paid from them interest over time. Then at the bond's maturity, you also get your money back. They are lower risk when compared to stocks, but that normally means potentially lower returns. What's an investment portfolio? It's a collection of investments across different assets such as stocks, bonds, and even cash. So, for example, if someone had their whole portfolio as 80% stocks and 20% bonds, they would be considered a growth investor. Whereas if they had, for example, 50% in stocks and 50% in bonds, that would be considered more of a balanced approach. There are many people who don't want to fiddle around picking their own stocks and bonds to make up their investment portfolio. So many people choose the mutual fund option, which is already a diversified mix of stocks, bonds, or both. It's managed by a professional, and of course, they take a management fee, which will lower the overall return. But it is good for diversification. There's all kinds of mutual funds that tailor towards somebody's risk tolerance, time horizon, and investment objectives. I picked up this chart from Dynamic Funds website, and it illustrates here how over the long haul stocks can outperform bonds and GICs. Now, this is not to say you should sell everything and go put your money in stocks. You should really consult a financial advisor, as it depends on a person's time horizon, risk tolerance, and financial goals. So, for example, if you're retiring next year and you've already got all the money you need saved up, you don't want to go selling all your safe assets and putting it in the stock market. Then all of a sudden we have a stock market crash and you lose 30% of the value. So that's something that is a consideration. Over the long term, stocks outperform, but they're a lot more volatile. Compound interest is when your money earns interest and then that interest starts earning interest also. Let's take an example. Mary starts to invest $100 per month, earning 8% annual return. Compounding annually for those 40 years, she ends up with $322,000. Now, Bob started much later in life at age 40. He also invests $100 per month at an 8% return compounded annually. He's going to have about $91,000 at age 65. 25 years later after he started. The point is, the earlier you start, the more that compound interest works in your favor. Now, at the beginning, I said that I would share a simple step by step plan to get your investment journey started. So here goes. Step one, pick your financial institution. If you bank with TD, for example, let them know you want to start investing in mutual funds. Step two, Let them guide you into what is the right mutual fund for you. Again, they'll do an investor profile and determine where you should likely be invested. Step 3, start investing your $100 and remember to make it automatic. Set up recurring monthly contributions and let it automatically purchase the mutual fund that you decide on. No more excuses. Start small, stay consistent, and let time and compound interest do the rest.